So now we're on to the exciting world of shareholders' equity. And honestly, I do love the equity section of balance sheet and don't understand why. Probably my financial side coming out. I love investments, bonds, and equity. One of the reasons why I really love teaching intermediate two back in Colorado. So we're going to really, there's going to be kind of two parts to this chapter. The first part, we're going to really concentrate on the contributed capital accounts. Um, and then we're going to look at the the other equity accounts like retained earnings and dividends, right? How those affect our shareholder wealth. So we're going to be talking about equity issuances and repurchases first. And just going to go into a brief overview of some of the issues with equity. I'm not going to dive into the 20 different flavors of preferred stock and all of the legal ramifications. That's kind of a B law class. Your finance classes might have talked a little bit about that as well. We're more concerned with the how we record it, how we report it, um, pieces of the puzzle, and some of the interesting pieces like preferred stock not really being equity, even though it's reported there. So let's talk about shareholders' equity. It's called the residual interest in the corporation. It's what's left over, right? Left over from what? That is, after all creditor claims are met, it is the value of assets that remain. That is the net assets. So whenever someone says net assets, what this is referring to is taking total assets and subtracting off total liabilities. And that, if you are familiar with the accounting identity, just gives us total equity. So it's the accounting equation that really gives us the mathematical identity of equity, but we call that net assets. And this represents the ownership interests of the company. It represents what shareholders will get, right? If we take this total equity and divide it by our outstanding common shares, pretending like there are no, in this case, pretending like there are no preferred shares. This is the amount of money each common shareholder is going to receive if the company stops operations, liquidates, and is no longer. Now, it does primarily consist of contributed capital, which is paid in capital, direct investments, right? But it also is comprised of the earnings that are just simply not paid out by the corporation, earned but not paid out. So that's our retained earnings, and those are sometimes called indirect investments. There are other pieces, but really, again, that whole common stock, additional paid in capital, if there is preferred stock, and then retained earnings make up the bulk of the equity section. There is also non-controlling interests, and that results from mergers and acquisitions. We'll look a lot more into that in the next part of the course when we talk about mergers and acquisitions and what non-controlling interests really are giving us or what they're showing, what they represent. Accumulated other comprehensive income. Remember this, please. This is something that I think is hard to really fit into an intro class, or sorry, not intro, an intermediate class, because you haven't done a lot of the transactions that end up in other comprehensive income. But do recall that unrealized AFS, gains and losses, go into other comprehensive income. And this is true too for any unrealized gain or loss on hedges, foreign currency translations, FCT, foreign currency translations, and some unrecognized pension costs. So you've at least Covered one of those in intermediate two, but understand that really very little goes into OCI. And also recall, if you will, that the reason we put these in particular in OCI is because OCI and therefore AOCI are transient, right? Income effects. We don't expect them to be, if they're gains this period, well, that's great, but that doesn't really tell us about anything about what's going to happen in the next period. We would expect it to be yet another gain. It could be a loss of the same magnitude, it could be a loss of a greater magnitude, right? The effect of these items is very volatile. We do not want it in net income, and so we keep it out of retained earnings. It has its own retained earnings like account. So the paid in capital portion can reflect a lot of different types of ownership. We got common, preferred stock, could be convertible equity securities, right? Some equity can be convertible into preferred or preferred convertible into common. It could be equity that's convertible into bonds, right? Or bonds converting equity. Tons of flavors, like I mentioned. But the primary one is, of course, common. Preferred is used by some companies, although not necessarily a lot of companies, right? The preferred holdings don't tend to be very widely used, except in maybe older companies. But remember that we separate out. We really do. When we are recording stock, we put this into two accounts. The contributed capital piece is always recorded at par. So we have a par value that restricts the amount that we can record as common stock or preferred stock. Any amount that we sell the stock over that par value is additional paid in capital. It's the excess of selling price over par. Um, the big distinction I really want you to know about common versus preferred is that common is the ultimate residual ownership. Right? These are the really what I would call the true owners of the company. They are the most equity-like of the equity pieces. And they are the most residual ownership because preferred stock obligations are met prior to distributing any other net assets to common shareholders. That's why when I wrote this, I said, well, we'll assume this total equity has no preferred shareholders. Then the amount each common shareholder is going to take from total equity is just dividing total equity by the amount of common shares and then multiplying by the shares that investor holds. But if there was preferred equity in this total equity, the outstanding common shares would not have access to that. We'd have to subtract off the amounts due to the preferred shareholders before we could say this equity should then be split amongst the outstanding common shares. Preferred stock is kind of tricky. It's called stock. It is included in the equity section, but really anyone will tell you this is more of a hybrid debt equity instrument than just equity. Why is that? Because preferred shareholders don't vote on matters put to the ownership of the company. This is a matter for common stock. A lot of these shares are held by a different clientele on average. Pension funds, investment funds, entities with company interests, like, some related business partners, joint ventures, right? This might be funding coming from another company entity that we are joining forces with in our operations or something along those lines, right? That's not to say that pension funds and investment funds don't own common stock. They do. It's just that if we look at the typical person holding common versus holding preferred stock, the the common person tends to hold common stock, while the common person holding equity stock tends to be some sort of an institutional investor, not just an average Joe stock trader. While preferred shares trade on equity markets, usually they're private placements at the outset. But the bigger piece is that when someone's holding preferred shares, they're not in that engaged trading mode where they're buying and selling preferred shares on equity markets ad nauseum, like common shares are traded. Preferred shareholders tend to hold their shares because what they want is the dividends on those shares. And from that perspective, because preferred shares are, for most preferred stocks, required and can be cumulative, right? They can build up over time when not paid. This becomes much more like interest than it does a dividend payment. Dividends on common stock are totally at the discretion of the company. They do not have to pay $1 in common dividends, but preferred shares are dividend rich. This is what people hold preferred stock for. To make it even more like a liability, some designations of preferred stock are called mandatorily redeemable preferred stock. Now, this kind of had its vogue circa 2009, 2011. Was a real particular flavor of preferred shares that caused all kinds of standard setting issues. I actually started a dissertation about this type of stock because it was wildly traded by banks. Um, but basically, the difference between it and other preferred shares were that there was a point in time in which the company had to buy the stock back. There was a mandatory or a mandatory put option on the stock where the stockholder could put the share back to the company and the company had to buy it. So then it became even more like debt because not only are we paying dividends, which for preferred shares can almost be more like interest, but then we were having to buy back almost like a maturity of the principal of debt, right? And so for all those kind of reasons, there really is this idea that while preferred shares are classified as equity, they should not be considered the most residual equity value. And like, for example, in financial statement analysis, we consider preferred stock a financing liability, not a financing liability, just to be clear and enunciate that clearly. We don't even consider it equity when we're analyzing financial statements and breaking apart their ROE and decomposing their ROE for analysis. So the first, the most primary reason for equity issue is cash, right? Issuing equity is one of the pillar financing options that a company has. So what is par value? It is essentially, but not always arbitrary. It doesn't tend the essential part of it doesn't tend to come up a lot. The essential part being that it represents the minimum legal capital per share that has to remain invested in the company and can't be paid out as dividends. So you know, if this share stock has a $1 par value, if they have 1 million shares outstanding, then they would have to keep $1 million in reserve at all times, not paid out as dividends. It does protect the interests of creditors so that the company just can't pay out all of its profits as dividends to the shareholders and therefore not have any money left to pay off creditors, right? It has nothing to do with the market value of the stock. Don't have to worry about that. Um, Many states, including Delaware, where most companies do incorporate, the lion's share, the majority of companies are incorporated in Delaware due to their incorporation laws. They allow no par value stocks, and this is very typical. And even if the company does not have a no par value, they have, for example, Apple has a let's see, that is a tenth, a hundredth, a thousandth of a cent par value. So it takes 1,000 shares to even get up to 1 cent of value. And so with that, with the billions of shares that Apple has, right, there's a tiny sliver of common stock that would be credited to common stock. But almost all of the equity is shown as APIC and retained earnings. Berkshire Hathaway, also with a stock that is trading well above um, a third of a cent, right? For its Class A stock, its equity balances, again, almost come entirely from APIC and retained earnings. APIC, of course, represents the amount above which, over par, that we sold shares. And so the par value plus APIC always gives the issue price. Just a real easy, quick, and dirty example. If I sold one share, a share of $1 par value stock for $20. Well, in that case, debit cash for 20, credit common stock for 1, and then additional paid in capital APIC for 19. In this case, right, this clearly shows, this is the easiest way for me and to always remember that all I have to do in order to know the amount of cash that was received from a stock issue is just to take the total of the APIC account plus the total of the common stock account, and that will tell me what the stock was issued at. Now, it tells me what it was issued at when it was initially sold. That is a big piece. So remember that common stock and APIC accounts are frozen at issue. We do not change them over time. If we issue more common stock, well, then that's fine. Whatever we issue in the future will go with these same rules. But again, we'll be frozen at those values at that point in time and will not change, right? The only thing that can remove common stock and APIC, the only thing that will only debit CS APIC. Offhand, I can think of two things: retirement, stock retirement, or liquidating dividend. We'll see in a second when we start talking about repurchases that repurchases do not debit common stock and APIC. We use a different account. We use a contra account for that. So the only times that we see common stock and APIC go down are under retirements of stock, liquidating dividends, and then maybe obscene amounts of share repurchases. But we'll get to that in a bit.